Mayuresh Joshi is now joining us. Mayuresh, good afternoon. What do you make of this last half an hour selling, Mayuresh? ETF flows continue to be negative, which has been the case in the last few days, or rather visible from the FII DII number.
Afternoon, Pankaj. Again, my own take is that we will be quite hostage to what the global markets do from an immediate short-term perspective, and very few triggers that the markets are probably working into going into earnings season. So largely, I think the markets, as we discussed time and again, have just stated weak numbers to come through. The first half has been reasonably okay, but the second of the earnings season, where PSU banks, infrastructure companies, construction companies, capital goods will start reporting numbers, I think the overall numbers will have a drag down effect. So I think the markets are probably reacting to what the global markets are doing at this point of time. Take into point cognizance of risk assets, equity being one of them. So I think this will continue for the short-term period of time unless monsoon surprises. And again, I think the expectations are largely that monsoons will be far better this year. So I think over the next few weeks at least, I think the markets will be range-bound. I think consolidation largely would be the theme, and volatility will continue for the better part of May.
Right, but overall numbers so far so good. Even in the second half, if we see a minor miss here and there, you would not be worried, right? Unless, of course, one very big company like a Tata Motor or, some big company, some company which has profitability of more than 3,000-4,000 crores essentially disappoints the street.
So again, I think companies having global exposure, I think largely it will depend on how the global cyclical recovery has been, both in terms of core commodity recovery as well as demand recovery, I think. So that will largely play into effect for a lot of these global players, specifically listed on the exchanges and specifically on the Nifty as a component. Having largely said that, my own take is that from the second half of this fiscal, you're probably working with a low base as well. So I think that is going to have a compounding effect in terms of how the earnings will pan out. Raw material prices again expected to be extremely benign, and if monsoons help, the pay commission recommendations help, a few of the reform processes that the government is doing largely get trickled down into the real economy, specifically in terms of how the money flow will happen. I think that will have a large amount of domestic consumption story getting driven up. And again, I think if the industrial demand starts coming back with the government capex largely on track, the private capex following suit in the second half, even in some bits, my own take is that the industrial recovery will also be largely evident over FY 17-18. So yes, I think we remain optimistic over that time frame. But again, as I said, largely I think till that point of time, you'll largely be driven by what global markets do, and will largely be constrained in terms of how cross-currency movements happen, which will also have an impact in terms of how equities as a risk-weighted class will respond.
So, the point that you made that, the overall base seems to be low now for growth next year. On a lower base, if we grow 15-18%, still investors would be happy?
So again, I think it was largely expected for FY16 that we will grow in double digits. That has probably not happened. It has got largely constrained because of all the conditions that I probably mentioned. But if one really assumes that over the next year, year and a half, or 2 years to say, the nominal GDP growth anywhere between 12 to 13%, you can largely expect inflation at the same levels or even lower. So I think the corporate earnings should grow at a reasonable pace of around 15 to 16 odd percent. And that is not a hard expectation to probably believe that the markets can deliver. So over FY17, FY18, my own take is with nominal GDP growth expectations of 12 odd percent, corporate earnings should grow at 15-16%, which should be quite reasonable for the market.
Right. What do you make of the private banks so far? Yes Bank, fantastic numbers. Axis, ICI slightly on the weaker side. How would you look at that, and also the new disclosures?
Again, the new disclosures largely are expectations from the banking side, specifically having exposure towards the corporate and the SME book. So I think we've got a broad outline in terms of what can actually go bad. Now, if the cyclical recovery does happen, my own take is that not all of these assets might actually get recognized to be NPAs. Having said that, probably I think the kind of disclosures that are made, I think it provides greater transparency in terms of how the cash flows might pan out for the banks. And again, I think if you divide that over the next 8 quarters, largely I think you'll understand how the bank's performance will be. So yes, I think if one really goes by the assumptions that the banks are probably giving out at this point of time, you might have a constrained earnings picture for the better part of FY17. But again, I think it largely points out with credit growth expected to revive over the next few quarters with the low base supporting these prices, earnings growth in excess of 20-24 odd percent in that range for banks, specifically on the larger retail side as well as the corporate and SME side, is not ruled out. So yes, I think the larger retail-oriented banks look a better picture at this point of time. But generally, I think the private sector banks should do reasonably better over the next 1.5 years.
The share that PSUs has been losing out and private sector has been gaining in, especially for the retail side. You think that will continue?
That might very well continue, and the larger PSU banks, which have a reasonable presence specifically in terms of the retail book or how the CASA ratios are even panning out for these banks, I think these banks should hold up in times, in good times. So I think once the credit growth cycle revives, when you've got a better base to work with, I think these branches already have a huge branch network. With the kind of impetus that has probably got received in terms of recovery of bad loans, I think these banks are probably doing the right steps. I think with the right kind of support that they're probably receiving from the government and the RBI, if the recovery process is as much faster than what the banks probably anticipate, my own take is that with the kind of valuations that these banks are deriving at this point of time, and the larger PSU banks at this one, I think the operating leverage benefits will accrue much faster to them rather than the smaller ones, because the smaller ones are still struggling with some amount of capital issues, you still start adequacy problems, and you need capital to fund your balance sheet growth. I think the larger ones really have that at this point of time. And again, I think if the market conditions support and if the macro conditions probably revive faster than one really expects, I think the larger PSU banks are looking good on both counts. I think earnings recovery will be much faster and valuations remain extremely attractive at this point of time.
Right. As far as earnings recovery is concerned, so private sector banks will continue to grow, but in PSU banks, one needs to be very selective. One has to play properly, even if they are looking to buy at these levels, which are about 30-40% from the highs that we've seen last year.
Oh yes, that would largely be the theme, Pankaj. So even on the larger private sector banks, I think the whole point would be to probably spread your portfolio across the private sector banks. And yes, I think you have to be remaining extremely selective when it comes to the larger PSU bank.
Right. For the PSU banks, can one create a basket or maybe buy a mutual fund which is focused on PSU?
No, largely, I think if you are going through a mutual fund scheme, I think one really needs to understand from a financial advisor which scheme suits you best as per your risk profile. But if you're looking at picking stocks individually, my own take is that the larger PSU banks will still offer a much better risk-reward profile at this point of time. Though the smaller and the mid-sized PSU banks are very, very attractive in terms of valuations, the inherent problem that remains on their balance sheet is capital adequacy. Asset quality again remains a big question mark in terms of how they'll be able to protect their book. And again, I think the kind of write-offs that one really expects on the lower PSU banks or the mid-tier PSU banks, I think their impact on the balance sheet will be much larger. So I think to expect earnings recovery and earnings growth in excess of what the market might do with the mid-cap PSU banks, the valuations remain extremely supportive on their side, is I think a high conviction call that one needs to take. But I think if I have to go for a steady earnings growth trajectory over the next 2 to 3 years, I think the larger PSU banks at least offer some amount of support in terms of what they've got in terms of branch network with the kind of management support that they've got, case in point being Bank of Baroda, where a new management has probably come through. So I think one really needs to be very, very selective within this space. But the larger PSU banks is something that still offer a better risk-reward profile, in my opinion, over the next 2 to 3 years.
Right. Mayuresh, any view on iShares? I think the press conference is also starting. Any view on iShares quickly?
No, it's always outperformed, Pankaj, in terms of how Royal Enfield sales have been. I think the cyclical recovery you're seeing in the MHCV segment is aiding margins. But I think the numbers were more or less in line with what the street was expecting at this point of time. Valuations also looking a little bit stretched. But again, the company has been a consistent performer.
Mayuresh, any view on Castrol? Very solid results came out today. It's up 6% now.
No, yes, I think the results were extremely good, both in terms of how volume growth has panned out, how the EBITDA contribution per litre has moved. But largely, I think you also should understand that the base oil prices have corrected quite meaningfully with the fall in crude oil prices that we've seen. And with some rebound that we've seen in crude prices, I think the base oil prices with a lag effect should see some amount of rebound as well. So with that aspect, I think the EBITDA margins, whether they'll hold up at the current levels and what kind of volume growth the management really expects, I think it'll be very interesting from the management to understand these aspects. But yes, I think operationally the numbers were very good.
Right, but something like a Castrol is like HDFC, where people don't believe that things would continue, but it tends to continue and tends to see growth.
Again, one really needs to understand the business model in greater detail, Pankaj. The automotive segment, the non-automotive segment, the automotive segment probably over the past few quarters had not done that great. But again, with expectations of monsoons picking up, you are greatly assuming that the volume growth should be largely better than what you've probably seen in the fiscal gone by. Again, on the non-automotive or the industrial part of the segment, I think with the capex recovery, I think you'll see some amount of traction happening on that front. So largely, I think the business model is skewed between these two segments. What kind of volume growth has happened over the past so many quarters? I think there is some amount of expectation that the volume growth might improve. But again, I think you need to keep in check how base oil prices move, how realizations move, how competitive pressures are probably moving in, and what kind of volume push through do these players really have within the market itself. So I think all these aspects need to be carefully studied. But no doubt about it, I think Castrol again has given a good set of numbers as I repeated earlier as well.
List, generally we don't talk about it. Have you looked at the name? What's the F&O data telling you? Gaurav, any view on Castrol? It's a part of F&O series.
Well, yes, I've seen a decent amount of short covering. Some good longs are seen now getting built on an intraday basis. Difficult to say whether these will be carried over, in the same amount for the next day. But so far it looks good. And I think if it's sustaining 405, 410, the chances in my test levels are 415, 430. So if somebody wants to go long, I think have a small stop loss and one can go long. There are chances that it may still move higher from the current prices.
Right. Gaurav, what's your view on DLF and Indiabulls Real Estate? These two names have not corrected despite markets going down. Generally, they are very high beta, tends to move with the market.
Well, they have been trading in a range. If you look at DLF or Indiabulls Real Estate for that matter, especially DLF, it's been trading in a range. And it's showing good amount of data in the sense that you see 120 call option having the highest Y concentration and that particular strike is being held on to. So that becomes a good base. And this way, it started with 110 strike, then 115 strike, then 120 strike. So the base is shifting up, and that is the reason we are not seeing good amount of fall in DLF, even though Nifty is seeing some amount of profit booking or some amount of pressure. This being a high beta name. For Indiabulls Real Estate, I think it's a different in a different league. Seen a good amount of longs, significant longs seen getting built, and we have seen that for last trading sessions it has been in the van period as well. So I think there's some more room left. But fresh entry at these levels, I don't think it is advisable to hold on to these levels. Fresh entry. But if somebody is already long at lower levels, then keep riding the stock and keep trading their stop losses.
Right. Mayuresh, what's your view on the real estate pack? Doing very well, and people probably want to own this name now.
Again, I think I'll be a little bit skeptical even at this point of time. A lot has happened in terms of developments to the sector as a whole. The real estate bill has come through, and again, if some sections are coming through even at this point of time, once the bill is fully implemented, I think you're going to have some amount of issues, specifically kind of escrow deposits that the builders have to do. Secondly, I think the core performance has not improved drastically, right? So the pre-sales are still very, very weak. You've got high amounts of inventory. So all the issues that were related to the real estate sector, which probably had dampened their cash flows, the kind of debt that taken on the books were taking a hit on their bottom line. I think all that still persists at this point of time. So I'm not seeing a cyclical recovery in demand coming through, specifically in tier 1, tier 2 cities. With affordable housing and the government focus, yes, I think the larger picture looks much better. But it looks much better for the picture for the players who are probably giving this segment to the end buyer. So again, I think one needs to be extremely selective. At this point of time, I think the better way of playing this would be through housing finance companies, in my opinion.
Right. So, as you said, that debt is one of the issues. Some companies like Oberoi, Godrej Property have very low debt. Would you want to go with them, or, even they are not that safe?
Again, I think if you look at the players operating out of Western India, I think if you look at the stamp registration data, I think it has not improved meaningfully quarter on quarter, year on year. So I think the kind of growth that one really expects to assume that the real estate sector is probably again in the pink of health, I think you're not expected to see that happen at least for the next few quarters as well. Again, I think the operational performance for both these players was a little bit on the softer side. And again, I think that entire trend in terms of soft earnings, in my opinion, would continue at least for a couple of quarters. So again, I think the better way, as I said, for playing this sector would be through housing finance companies. What happens once the bill is implemented again? I think it is going to have some amount of issues in terms of cash flows for the companies going ahead, and in turn impact the return ratios as well.
Right. So, as far as real estate is concerned, you mentioned that there were other ways to play as well. Housing finance companies, there you think valuations are particularly quite high to play the story?
So one really needs to understand the kind of mix within the housing finance pack as well. Who's catering to the retail side, who's catering to the loan against property side, who's catering to the developer side of the market. If a cyclical recovery does happen, I think the stress that you're probably seeing from the LAP and the developer market would start reducing down. But generally, I think the advances specifically on the retail side would assume to be growing at a very good pace, and I think that assumption would still hold good over the next 2 years in excess of 20-21 odd percent generally for players operating within this space. I think what this entails specifically, Pankaj, is that the earnings growth can be in excess of 20 odd percent, and the cost to income ratios are pretty low as well for a lot of these companies. So credit costs expected to come down, the cost of borrowing expected to come down with RBI cutting rates. If that happens, I think greater transmission seen in advances. If advances happen at a much faster pace, my own take is that the earnings growth of 20 odd percent can be easily sustainable by these HFCs.
Right. Gaurav, what will be your view on a company like HDFC? It has done very well after the results. It's up 7% in the last 2 days.
Levels of let's say around 1180 to 100. This is the zone from where we have seen some amount of pressure coming in the previous occasions as well. Some amount of unwinding cannot be ruled out. And if at all, if we continues to hover around 7,700. These are some of the stocks that will see some amount of profit booking, because to anticipate a fall in the market or anticipate a fall in a particular stock would be a little bit difficult at these levels. These are not the levels from where one can either go aggressively long or short. And that comes to the next point where one can have a profit booking. So if somebody is having a decent amount of portion in HDFC Bank or some of the other banks, the lower levels, then I think they will see some more pressure in coming days.
Right. How would you look at some of the other housing finance companies? Maybe a LIC Housing where the trading interest is quite high?
It's given a breakdown. It's seeing good amount of short positions, so I would recommend going short in the stock. But a little bit at high levels, around 450, one can have a short in the stock, have a stop loss of 460, play for targets of 435 to 430. I would still be skeptical about it. SKS after the result, it's been a little bit stable. So if it's seeing a 580, 590 levels even after a couple of days, then I think the buying interest would still emerge and we may see levels of 630, 640. So I think if tomorrow the stock closes in the positive note, one can go ahead and buy a 620 or 640 strike call option. That would make sense for entering into HFC names.
Right. Mayuresh, what's your view on United Phosphorus Limited? It has done extremely well after results.
I was very optimistic on the stock for a long period of time, and again I think the story holds good for a player like UPL, completely integrated in terms of front to back end operations, expectations of generic products of close to $3 to $4 billion going off patent over the next few years. What this really entails is top line growth of around 10 to 12% on a CAGR basis over the next 2 years, bottom line growth of 30 to 15 odd percent, and that should probably sustain. Now what will happen going forward will be the kind of capex that these guys do, and if these capex plans are much larger than what we really expect at this point of time, that might have some amount of dampening effect from a short to medium term perspective. However, I think the results were extremely encouraging in my opinion, and the general business outlook looks extremely robust for a company like UPL.
Because it has seen such a sharp rally, you would want to wait for a correction before you advise somebody to buy into?
So again, Pankaj, I think we did like the stock at much lower levels. I think it has moved up quite sharply over the past few months. So again, valuations have become a little bit on the higher side if you have a trailing comparison done. So largely, I think it will now depend on what kind of plans the management has in place. I think the business model is largely understood by the market, and the kind of opportunity that a stock like UPL can probably garner in terms of market share from innovators who specifically have some of their products going off patent, as I mentioned earlier. However, I think valuations will be a little bit of a headwind from a medium-term perspective. So yes, I think fresh investments need significant declines, but investors holding on to the stock should continue.
Right. Mayuresh, thank you so much for taking out time for us. Always a pleasure talking to you. Gaurav, your view on United Phosphorus Limited. How do you see that name? The rally that it has seen, can it continue?
The positions are still long, but for fresh longs, I would not be advising. Probably a correction is what I would be waiting for, and then take a position in the stock. As far as how far it can go, it's seen good amount of breakouts, seen good amount of longs, so it becomes very difficult to pinpoint exactly when stocks at 52-week high or even higher, much higher than those levels. So I expect a 3 to 5% upside from here, at least from the current closing prices. And as far as longs are concerned, fresh longs, I would still say I would not be advising fresh longs. Dip can be utilized to go long into the stock, but around about say 570, 575 or 560 to 570. This zone looks a little bit interesting. If it's holding on to these levels, if it drops down these levels, then I think it makes sense to go long. Otherwise, fresh entry should be avoided.
Right, but those who are already long should stay long, as you said that the momentum is positive.
Yeah, of course. If somebody is already long, it's given good amount of momentum. It's given good amount of chances for people to go long into. So people who have bought into the stock, I think then they should hold on to the stock, keep trading the stop losses. For them, the stop loss should be around 575, 580. And if these levels are sustained, say if 600 is sustained, then expect another 4 to 5% jump coming in the stock.
Right. How would you look at Adani Ports? It's fallen quite a bit after the results 2 days in a row. 8% down one day, 10% down one day and today down another 5.
I would still wait. The chances for selling, I think it's seen good amount of shorts and price movement has already happened. So there's a chance that even if market sees levels of 7,800 or so, we may see some short covering getting triggered. It might not amount to 10% upside, but even the stop losses might get triggered. So these are not the levels I would wait for ideal levels to enter into the stock. For now, it would not be on my list. I would still avoid, at least for the time being.
Right. What would you do with, something like an SKS Microfinance? It's done very well before the results. Results came out today. It was quite volatile in the morning, but then stable at 600.
I would still wait for a day at least. If by tomorrow closing, if you see the stock hovering near 600, then I would like to play with the options. 620, 640 strike call option would make sense. There's some amount of risk as well. It's seen good amount of upside from 500 levels, so the profit booking factor would still be there. So and below 580, the stock will have aggressive unwinding that can see the stock towards 545, 550. So the risk reward would not be that favorable if somebody goes long into the stock, and that is the reason I would say that one can go long on 620 or 640 strike call option if the stock trades above 600 or around about 595, 600 till tomorrow end.
Right. How would you look at Idea Cellular 113 today, back to the result lows?
It's weak. It's sell and rise for now. A buy would be garnered only above 120 levels. So as long as it trades below 120, the chances are it may test levels of 105 or so. At 113, I think the risk reward might not be that favorable. If somebody wants, one can initiate a 110 strike put option. That would be the safer way to play it, or else wait for a little bit upside, let's say around 115, 116. If those levels are coming, then have a stop loss of 119 and play for targets of 110 to 105.
Right. How would you look at Bharti as well? That's not
Well,
as weak as Idea, but how would you look at Bharti?
It's not as big as Idea, but if you look at historical levels, then 355, 360 is the zone from where whenever the stock has failed to sustain these levels, it's seen a fall in 345, 340 levels. And that is what I would be advising, that I have a stop loss of 360 and targets would be 345 to 340.
Right. Just a word on the Nifty and the closing today, 29 points higher. What is your strategy on Nifty?
Well, 77 seems to be decent support, but I would still wait for a confirmation. It's always better to buy a little bit higher levels, because if you look at last 2 days, 7760, 7770, it seems to be a very daunting task for Nifty to actually cross and sustain these levels. I'm talking the spot levels. So as long as it trades below these levels, I would not be recommending anything to my clients. It's a wonderful sell below 7700. It can fall by 150 rupees in a matter of days below 7700 spot levels. For buying, I would still wait above 775, 7770, that is 30, 35 points up from here. I think that would make sense to go long, then have a stop loss of 7720 and play for targets of 7900.
Gaurav, thank you so much for taking out time for us. Always a pleasure talking to you.